Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Samantha Paxson, the Chief Experience Officer at Co-op Solutions. I enjoyed this. We've been really wanting to talk a bit more about digital experiences and particularly the ability to engage users and sell additional products to your current users. And that's really what Samantha focuses on. So we dove into how you drive loyalty and importantly, engagement, ongoing actions from your users where they're engaging with you on a regular basis, how you understand their financial position to understand that next best product, effective ways to position other products and cross sell. And she really focused on starting with not the product that you want to sell, but the consumer's perspective and keeping the consumer's point of view at the center of building your journeys, building your experiences. I think a great reminder and a lesson for all of us about how you really deliver for the consumers to make sure their perspective is the one that is central to how you think about designing your different experiences and products. So, with that, please enjoy this conversation with Samantha. Samantha, welcome to the podcast. Thanks so much for joining me today.
Thanks, Jeff. It's great to be here.
Yeah. So, I've been starting with this. I don't know if this question will work for you, but I've been starting with all my guests with this interesting question of like, most of us didn't grow up dreaming of being in the banking space. It's not, I had different visions as a kid. Well, what was the path that led you to being in the financial services industry?
It's funny. I started my career in journalism.
That's not financial
Journalism,
services. Yeah, for sure.
yeah, it's not financial services. Journalism and entertainment, public relations. And I worked for a strategy and marketing consultancy. And one of my clients, I'd been there about 10 years, and we had a client that was an ATM network wanting to go national. And that ATM network was called Co-op Network at the time. And they asked me to start their marketing function within their company. And this was right at the advent of the iPhone. So I thought I would be there 2 years. I was the youngest VP ever hired. I started a brand new function. And I left this really sexy industry to go work in financial services, which sounded really boring. And all of a sudden, technology started taking off and it became a really, really interesting industry really fast. And my company expanded from hardware to payments and money movement. And so all of a sudden, I had a ton of freedom. I was in a really exciting industry that was expanding. It required a lot of ongoing learning, a lot of being able to be really nimble and shift quickly. And that was exciting to me. So I stayed. And all of a sudden, I'm in the payments industry and all of these use cases that have exploded in financial services. So it's actually a really exciting, fun sector to be part of.
Yeah, I've been really enjoying my conversations with people in the technology partners to FI's side. 'Cause I think there's just so much interesting, innovative stuff going on in that space. Give us a little quick overview of how your company works with financial institutions, the kind of the core things you do, and then I want to dive into. I think it's really interesting because you guys are really focused, in my opinion, on one of the areas that FIs need to get better at and need to move into the digital age in some ways where their historical hasn't been. So, but talk to me a little bit about what you guys do, and then we can dive into that.
Well, I'm the chief experience officer at Co-op Solutions, and we are a payments and financial technology company helping the nation's credit unions be able to compete with fintech, big tech, and big banks. And what we do is we create all of the use cases, the payment and money movement use cases, and all of the things that surround that, the loyalty, the fraud mitigation, the consulting, the integration work, all of those things that surround payments, and have created essentially an ecosystem that is really capital intensive for credit unions or traditional FIs to create on their own. So we aggregate all of that technology. We've connected the tech stack, we've connected the data, we put all of the security wrapped around it, and then we can add new use cases all the time with the objective of building a stronger financial relationship between the end consumer and the financial institution.
How do you measure the strength of that relationship? It's an interesting objective, but then my mind goes right to like, how does one determine if one has achieved such an objective? How do you think about measuring the strength of that financial relationship between the consumer and the institution?
It's a really good question. So often, traditional financial institutions look at revenue, they look at product revenue.
Yep.
And you can look at product revenue, and all of a sudden that will fall off a cliff, kind of like we just saw as we've been seeing in the lending space.
Mm-hmm.
So many credit unions, that's their bread and butter. They look at that, those financial results are a lag metric. Really, what the key metric is the end consumer actively using you. So what I think the objective needs to be for financial institutions is to grow market share, and to grow market share through active usage. That's why we call it a primary financial relationship. There is no such thing as a primary financial institution anymore. The average consumer has 5 different financial relationships at least. They're incredibly empowered. So how are you, in the moments of every day, creating a connection and an interaction with the end consumer? So measuring interaction, measuring usage, that helps you better understand end consumer economic participation in your financial institution. And to me, that's the way. If you start with the consumer and measure from there and work backwards, and then design your institution around that consumer, you're going to see deeper usage, and you're going to see better economic performance.
The hard part about that, I think, for many financial institutions is that they're often the business owners are product line owners, and getting an incentive and a culture and a set of capabilities that are focused on the consumer across those products is hard. And I'm curious the lessons you've learned from clients that have done this well, better or worse. What's worked? Because that feels like the organization. You said the organization, and I feel like organizationally often we're set up siloed into products and not focused on the end consumer. And that ultimately, as much as the technology can be the challenge to executing a vision like that.
We have to get out of our own way. You're 100% right. It's partially it's because of our organizational structures and our operational structures that are making it difficult for us to grow. And so we have to kind of shelve that. And um, as financial technology, we should all think of ourselves as financial technology companies. We have to start with the end user, and how are all of the ways that we are surrounding that end user, and how are we meeting their needs in every moment, and how are we taking out the points of friction. And I think you have to kind of get rid of, or look at it from a clean slate perspective rather than a business line perspective, in order to make sure that we're not letting those traditional frameworks create a barrier for us to actually properly serve the consumer, who is incredibly empowered to go find their own way, their own stuff, to meet their needs. They're incredibly empowered and incredibly comfortable. And any point of friction, they're out. So, I mean, for example, I have a relationship with a credit union in my neighborhood, and I have an auto loan there, and I wanted to open a credit card. The new member team did not talk to the auto lending team. They did not understand. They already had my data and could cross sell me these things across the board. And so I had to keep going back to the credit union to go wet signature my way into it. And I'm like, you already have my information.
Yeah.
It shouldn't be this hard.
I
And
had
so
this
it just shows the silos in those
I
institutions.
had this really funny version of that. I worked as a large national bank that I have a relationship with, and they had some of my investments, like my 401k was there, that my IRA that I'd roll everything into, and I asked them for auto loan. I said, "Well, you have to go to the branch. We can't help you with that." And I went, Yeah, I gotta like walk. Like I can't call my get no. And so I said, forget that. I'm just gonna go. And I was buying a Tesla, and they offered me an online loan through Tesla, and it turned out that my bank funded the loan, but they could not offer me an online loan unless Tesla was offering me the online loan that they were funding. I thought that was really fascinating. That like they ended up getting the business, but through no credit to them, other than the decision to partner with Tesla, because they couldn't offer me an online or a digital experience for an auto loan, but they would do it through a partner. And that was just such a fascinating reality. I went, you guys are, you have not engendered any loyalty. I'm not coming back. I'll just go to Tesla the
Right.
next time, and you may not be the person who gets it or whomever, but you lost the sense of loyalty where I came to you first and you couldn't help me. And that seems like a terrible place to put yourself in terms of keeping
It's
customers
the
loyal.
way loyalty is such a good word. I'm glad you brought up that word. That's where the battle for business is being fought. I mean, we look so much at the value proposition of the traditional financial institution, and we've been a very rate based
Mm,
um, value deliverer centric. It's not very eloquent, but we've been very focused on being a low price leader as traditional FIs. I think consumers today care as much about time and as they do about rates. And they're not always, I mean, how often are you shopping for a loan? Every 5 years, maybe? It's this is where financial technology companies are really um, beating out traditional FIs because they are in the interaction game. They are masters of interaction and engagements, and they know how to build habits based on consumer need, and they study it really well and they get really good at it. And so this is the opportunity in front of traditional FIs to do the same thing and to throw out these misconceptions. And that's why we're so focused on payments, because payments are a daily habit. They're a daily way for the end consumer to get what they need to get done. And so if the nation's credit unions can play in that space and do it in a friction-free way, that leads to more loans. I mean, those are ways that you're deepening the relationship to build engagement across the product lines within the traditional FI.
yeah, it occurs to me. I want to dive into this kind of habits part, but it occurs to me you're saying two things that are kind of totally separate and different and can mislead someone, which is really interesting. One is like in the moment of a transaction, you have to have little friction, which is like you want time on site, for instance, to be small to complete the transaction. And then you need things that are habit based, where like habit based apps look at how often do you come to the site, how long do you spend on this site, how many things do you do on the site, and you want those to be large. And if you use the wrong metric for the wrong experience or don't understand the difference between, hey, I came here to transact, you need to make it as fast, easy, simple. Don't ask me the things you already know. Get me through the process. I don't want extra interactivity. I want to be done. You got to separate that experience from the daily interactivity where you want, like, I want you to be engaged and coming back regularly and staying on and looking at different pieces of content. Just very different metrics for different kind of use cases, which is really interesting because that frictionless and then the interactivity and engagement are like very different sets of experiences you're trying to build.
I like that idea of um, kind of separating the two. Like this idea of in the transaction, making it as frictionless as possible, but then what are the ways for us to add value? So that's what would make me want to engage. So this is why you're seeing so many organizations offer the ability to view your credit score. Those are ways that I'm like, oh, I'm going to go back to my Capital One app to know how I'm performing, or in my Wells Fargo, or in my Connected Credit Union. It's something that helps me understand my financial position. So we've done some proprietary research at Co-op with EY that really looks at what is driving a deeper financial relationship. And what we've seen is that fintechs have grown year over year 505%. They've built trust and loyalty in 1 year, 21 to 22, 505%, with PayPal being the most trusted brand in financial services. And the way that they've done it is that they've focused on payments because it's an active type of relationship builder, and they focused on needs. So there's use cases that show up in the top, where they're getting the most engagement. And when you break down those use cases, those are about helping the end consumer first understand their financial position. So if you're an empowered consumer that has on average 5 different relationships, it's hard to understand how you're performing. How am I doing financially? Do I have the right behaviors? Do I have a clarity on my overall financial position? And then second, once I know that, what kind of actions do I need to be able to take to improve that financial position? So this is where the idea of financial wellness and financial well-being comes in. And that's where kind of you breaking up this idea of being friction-free
Mm-hmm.
in the transaction, which makes it, okay, you're saving me time.
Yep.
Now give me value. And that value is about helping the end consumer reach their overall financial goals, whether that's short-term or long-term.
Now, I really want to dive into that a little bit and understand what you're seeing people invest in, what's working. Because I do feel like there's at least 2 things that come to my mind immediately. One, like the kind of check your credit score, which obviously a number of fintechs have built their whole business around, helping you understand your credit score and then finding loan products based on that information, like recommending to you cards or auto loans or personal loans or whatever in that moment, or mortgages. Um, and then there's this kind of like daily transaction, like what am I spending? Am I spending too much? How much do I have left on my whatever, that maybe typically I think of as a credit card app, but doesn't have to be. I'm curious if there's other habits you see that financial institutions are building to or kind of capturing, because those are 2 that seem obvious, that have been frankly captured mostly by a handful of credit card banks effectively, and a handful of fintechs effectively on each side. I'm curious if there are other things you're seeing, or if you're seeing people really trying and go after those 2.
They're wanting to see, they're wanting to have their overall financial habits and their behaviors aggregated. So organizations that are bringing in your bill pay data, your payment data, your your budgets, your wealth performance. If you're able to kind of aggregate those and give a holistic picture to the end consumer, that's really good. The things that they're also doing, having access to a virtual financial advisor, being able to have access to your money 2 days before your paycheck comes in. Chime's doing this, and they are growing members, growing that relationship more and more and more and more. It's those types of activities. And then on the transactional side, it's contactless payments, it's digital payments, it's buy now, pay later. It's having the ability to trade crypto from the app, to just get in a game. I not necessarily advocating for that, but it's just being able to create that interaction that is really making a difference right now.
Or even if you have crypto, I mean, I'm a big see one, do one, teach one learner. So I've traded some crypto just to feel like I can't understand it unless I do it. I don't fully understand it, but I am doing it. But I have to go to second place. Like I can't go to one place and go, what are my outstanding credit card balances? What is my cash balance? What is my crypto balance? Like I can't, like I have to have at least 4. I got a spreadsheet that I go to 5 sites once a month and go pull in all my balances and tell me
Bring it all together.
right. And try and get a picture. And that is real value that's not being, that most institutions and even fintechs aren't fully providing kind of that complete view.
That's why we see such an opportunity in payments. Like, did you realize that you have X number of subscriptions that you could be not having? That this is, those types of things. In my own house, our Apple bill sometimes is, $200 a month. Wow. And that's, I know, it's like the New York Times subscription, the Hulu subscription, the Disney Plus, it all aggregates into that one, and all of a sudden you're spending real money. So it's those are the values, that's the value that I feel like it's an opportunity as financial institutions,
Hmm.
and it's also part of our purpose. I mean,
Yeah.
if we really see broader business trends and broader business strategy, consumers are attracted to companies that have a purpose. And it isn't just something that we say, it's something that we do. And this is something that we could really be helpful for people in the way that they are behaving because they're losing track of what they're doing. So
Yeah.
just being able to give them clarity about their financial life and then giving them first actions, which is why Chime is so successful right now. Is like, okay, here's the first action. I'm going to give you access to your own capital
Yep. Here's the
by
first step.
giving you funds to your paycheck 2 days early. That's just a simple thing to do.
So here's my next question. It's fascinating to me that, like, where does this live in the credit unions you work with? Because if I think about experiences being mostly driven by, again, lines of business, this is like almost a product set that's at the same time both non-revenue producing, right? In some ways, right? These things don't. I mean, we haven't used the word cross sell yet, which I think is ultimately how you monetize this. But it is a product for which the basic experience is like non-revenue producing, right? You give somebody a free credit score, you don't get any
So
money.
here's what's interesting. We can't look at revenue by product. We have to flip our thinking.
Yep.
We need to look at revenue by audience. So, what are the products that come together in order to drive what one credit union is calling member economic participation? So, you look at your audience segments, you really get to know them. You look at we're swimming in data. What insights are we getting from the ways that our members are behaving and which ones are the most engaged and which ones are the most profitable? And how do we get, on average, the member base of a credit union, the consumer base, only 20% of them fully utilize that credit union or that financial institution. That's service being left on the table. That's money being left on the table. So if we're only looking at it product line by product line, it's a huge missed opportunity. We're looking at it from you're already behind. If you're only looking at product by product performance, your end consumer does not look at you that way. They look at you holistically. They look at what are all the things that I could do here. And maybe they don't even look at you holistically. They're just looking at what are all the things I need to get done and how can I get that done. So the more that we look at it from, you have to start with the human and say, what are all the things, and really deeply understand this, not only the demographics, the psychographics, the deep segmentation of your existing consumer base, and say, how can we better improve usage by our existing customer base and grow from there.
I guess my question is really, how do you seen that work effectively organizationally in the credit unions you work with? Because I feel like, if I'm the person who runs lending, then I've got a certain hat, and putting in these kinds of capabilities doesn't. It's a cross product vision, but most of us are product oriented. So is it a chief experience officer? Is it I feel like if you did it by committee, like, well, it helps everybody a little bit. So all of our senior leaders are going to like contribute a little bit to the building of these sets of capabilities and ownership. It's going to like, I don't know. I think of committees as places things go to die. So like, how do you see the organizations actually structured to deliver that? Because I feel like that's where the idea can work. But then if you don't have the organization and the incentives across the leadership in the organization, then this is like, yeah, we should totally do that. And you're going to get together at your next quarterly meeting and go, we've made no progress towards it, but we all like did this little thing in our product area that got a little bit better, and we haven't even come close to attacking this vision. So that's my question is like, how do you organizationally, incentive wise, actually get to a place where somebody owns and drives this kind of vision instead of capabilities that are outside of the kind of traditional product lines?
It's a really good question. I'm seeing one credit union do it well right now, and they're kind of embarking on it. They've been planning and kind of re-looking at their credit union from the member's perspective. And so they did a ton of research on their, not on product, but on their existing customer base. And they have been focused on who they are targeting. So they were able to get a clear understanding of what kinds of members in my credit union are the most active and the most profitable and are driving the growth of this credit union. So they were able to get out of the product view and get out of individual product performance and look at all of the things that they have, and they're measuring engagement and interaction. And then based on those member types, they are prioritizing where they invest based on that member's behavior and where they think that member will be going. So this is actually the credit union that coined the term member economic participation. Their objective is to improve usage and then economic participation. So you might be in the old way making a decision about credit score or Zelle or something that seems expensive and you're not going to see the ROI on it, but you're not quite understanding how those products are then tying into 4 other products, that they are creating usage with your credit union, which is then improving overall cross sells or cross usage of all of your solutions, which is creating active participation in the credit union, which is then creating more usage of big ticket items. So it's that what this credit union has done is thrown out the silos, and they have come together to say, how in each of our roles are we driving more usage with these member types? And then they are making choices prioritized on the member, not prioritized on the divisions that they run or the products that they run. They are authentically understanding, transparently understanding how they contribute to not only improving the ways that their members use them, but improving their value proposition to that member. How am I helping to serve that member more so that we're not losing them to fintechs? It's like the Blockbuster Netflix example. Blockbuster was still performing pretty well up until the end, but all of a sudden they ran out of customers. And this is essentially, we can't let our existing structure harm our market share, and we are losing market share, and we are seeing it among traditional financial institutions and credit unions, and we're also seeing the American consumer really believe that traditional FIs do not provide the service that they're expecting. So they're going elsewhere.
I mean, it is. I was speaking to some credit union CEOs last week, and I feel like one of my messages was, you've never lived in a more competitive and an easier to switch world, right? It used to be you were competing with the people down the street who had a branch that your customers could walk into. And now you're competing with Goldman Sachs and Marcus, right? You're competing with all sorts of national companies, and they have more ways to check. Like they can go to Credit Karma and LendingTree and check rates on different products. And so you're living in a very different competitive environment than we did 15 or even 10 years ago, where competition is much broader and much more readily visible to your consumer than it was. And so if you're not finding ways to add value outside of, I mean, like my auto loan, I think is a great example. I went to my institution and they had gotten the right for the first shot at my business, and they blew it, right? And you've got to be both helping that consumer in that moment and giving them a better experience because of their current relationship with you, or you're not going to earn that business in the long term.
So Jeff, what I think is really interesting is that most financial institutions do not have payments on the executive team. Payments is the daily interaction with the end consumer. It is the way that you're building a habit to use your credit union or your bank. And when you kind of put baby in a corner, your head of payments or your head of digital experience, if you have one, not represented on your executive team, who is advocating for that active usage with the member? Who is advocating for you building market share? This is something that is a miss. It is something that we are not. What I'm noticing in credit unions is that we don't prioritize payments. We leave it because it traditionally has not been the big money maker for the credit union. But most credit unions are now seeing I have to have more balance in my interest income and my non-interest income. That's economic performance will align to your members' behavior with your credit union. So instead of looking at it from the product line by product line perspective, you have to look at it holistically with how the member is participating across your financial institution, and then how those lag metrics like economic performance are then coming as you designed your credit union in that way.
It's interesting that I might sum of this whole conversation is your institution needs to be greater than the sum of its parts. And too often we think of it as the individual parts and we add them up, and we don't. There is a greater sum there if we can actually bring the experience together and have an experience for the consumer that is better than what my mortgage experience was, or my debit card experience was, or my checking experience was, but across those.
So you were making a really good point, Jeff, about this idea of the whole being greater than the sum of the parts. And I think as traditional financial institutions, we do look at each of the parts and say, how should we plan for each one of those divisions of the business? We need to look at it holistically and see how those things all come together in order to be in service to the end consumer. How do we continue to optimize the design of those functions to then deliver huge value at speed? This is why consumers are gravitating to technology, because they are able to kind of deliver in an algorithmic way. They have transformed into technology stacks in a way that the end consumer is very used to engaging. There, we buy off of Amazon. We Google something that we need. There is an immediacy to our behavior, and that's what they expect in financial services. We have to act like technology leaders.
Absolutely. Well, this has been a fascinating conversation. I think a lot of value. This is topics I've talked to a lot of institutions about. What I love about your perspective, Samantha, is like you're seeing across institutions in a way that I think they can learn from. That's hard for them to see just in their own experiences. So I appreciate your time. I have 3 questions I ask everybody at the end of this podcast. So if you don't mind, I'm going to throw them at you now. Number 1, what's the best piece of career advice you've ever gotten?
Be fearless.
Be fearless. You didn't hesitate, man. You
be fearless. Go for it. If you see a problem, go solve it, and be an advocate for that. And when you are solving problems, you're adding value, and be fearless in solving problems. If it's going to be good for your market, it's going to be good for the business. And I've never been fired for really doing the right thing for our market. So I'm fearless and unabashedly confident in that.
My second closing question is always, what's the best piece of advice you've gotten about consumer lending or consumer banking? I guess this one we've talked a lot about today in general, but would love kind of the best advice you've got on the consumer banking front.
Well, it's something I've been saying all day. You have to design for your end consumer. And so often we think about lending and any product through our operational lens. We are missing the moments to capture to capture the opportunity and to capture more volume.
Provide more value,
and more value when all we're focused on is the rate. It is, to be candid, lazy. We could be so much stronger and so much better for our market. And they need us. They need us to be better, and we can.
Yeah, it reminds me of this old Silicon Valley saying, don't ship your org chart. Like too often the customer sees in the product and their experience, our organization, we've optimized for our org chart and not for their perspective of what they would like to do.
It's so true. That's so true.
That feels like what you're saying a lot. All right, my last question. What is one bold prediction for the future?
There will be more things that we are not anticipating, more technology.
The last 2 years have taught us anything about that.
Right?
I don't think we've taught us that.
Right. There are going to be things that come into our space that we cannot anticipate. We've seen it happen. And we've proven to ourselves that we can do hard things. We can pivot a lot faster than we thought we could. And so we should lean into that enthusiasm and that confidence and that optimism that, wow, we just made it through a pandemic. We just proved to ourselves that we can deliver in a completely digital way and serve the end consumer. Let's not go back to the way it was before. Let's lean into this idea that change is normal. It's going to happen faster. And let's remember the idea that we can do it. So that's my closing thought, that things like crypto and AI and completely digital service, those are table stakes, and there's going to be more with the advent of Web3, all of these new things that are coming about. So be optimistic about it. Say I can do it, and let's keep going.
All right, I think that's a great closing thought. Samantha, thanks for joining us. This was really fabulous, and I enjoyed the conversation a lot. I'm sure the audience will as well.
Thanks, Jeff. So great to be here.